Imagine waking up tomorrow morning, checking your phone, and seeing that $217 just appeared in your bank account. You didn't work for it, you didn't sell anything, you didn't hustle or grind, the money just showed up. Now imagine that happening every single month, without fail, for the rest of your life. Sounds like a fantasy, right? But there are millions of people right now, ordinary people, not millionaires or trust fund kids who are collecting checks every single quarter just for owning pieces of companies. They're getting paid to do absolutely nothing. And the craziest part is that these payments keep growing year after year. This is the power of dividend investing. And today I'm going to show you exactly how regular people are building income streams that pay them forever, even while they sleep, even while they're on vacation, even after they retire. This isn't some get-rich-quick scheme. This is how the wealthy have been quietly building generational wealth for over a century. Let me tell you about a guy named Ronald Read. You've probably never heard of him. He was a janitor and gas station attendant in Vermont who spent his entire life living in a tiny house, driving old cars and wearing the same jacket with safety pins holding it together. His neighbors thought he was just a regular working-class guy scraping by. When he died in 2014 at age 92, everyone got the shock of their lives. This janitor, this guy who looked like he had nothing, left behind an $8 million fortune. $8 million from a janitor's salary. How is that even possible? The answer is dividends and compound interest. Ronald Read spent decades quietly buying dividend-paying stocks, reinvesting every payment, and letting time do the heavy lifting. He never made a six-figure salary, he never started a business, he never won the lottery. He just understood something that most people never learn, that you can own pieces of profitable companies that will pay you a portion of their earnings forever. So what exactly are dividends and why should you care? Here's the simple explanation that changes everything. When you buy a stock, you're buying a tiny piece of ownership in a real company. If that company makes a profit, they have a few choices for what to do with that money. They can reinvest it back into growing the business, they can buy back their own shares, or they can distribute some of that profit directly to shareholders as cash payments. Those cash payments are called dividends. Think of it like owning a rental property. If you own an apartment building, tenants pay you rent every month. You didn't build the apartments that month, you didn't do any extra work, but the rent check still shows up because you own the asset. Dividend stocks work the same way. You own a piece of a business, that business makes money, and they send you a check just for being an owner. The difference is you don't have to deal with broken toilets, difficult tenants, or property taxes. You just collect the payment. Now here's where this gets absolutely wild. Let's say you buy $1,000 worth of a stock that pays a 4% dividend yield. That means every year you'll receive $40 in dividend payments just for owning that stock. Doesn't sound like much, right? But here's the magic. If you take those $40 and use them to buy more shares of the same stock instead of spending them, a process called dividend reinvestment. Now you own more shares. Those additional shares also pay dividends. So next year, you're not just earning dividends on your original $1,000 investment, you're earning dividends on $1,040 worth of stock. The year after that, you're earning on even more. This snowball effect is how people turn modest investments into income machines that eventually pay them thousands of dollars per month. I hope you're doing well, and if this is opening your eyes to possibilities you never knew existed, please subscribe to my channel and hit the bell icon. Because I'm going to keep showing you exactly how regular people are escaping the paycheck to paycheck trap and building real financial freedom. Let me break down some real numbers so you can see the actual power here. The average dividend yield in the stock market is around 2 to 3% for solid companies. But there are plenty of reliable companies paying 4, 5, even 6% or higher. If you invest $10,000 into a dividend stock paying 5% annually, that's $500 a year in passive income. Now that alone isn't changing your life, but watch what happens over time. If you add just $500 a month to that investment and reinvest all the dividends, after 10 years with average stock price growth and dividends, you're looking at over $95,000 in total value, generating around $4,700 per year in dividend income. After 20 years, you're potentially looking at $300,000 generating $15,000 per year. After 30 years, we're talking about over $700,000 throwing off $35,000 annually in passive income. And remember, you're not selling anything. You still own all the shares. This is just the cash being deposited into your account every quarter for doing absolutely nothing. But here's what separates people who actually build dividend income from people who just talk about it. Consistency and patience. Most people hear about dividends, get excited, maybe buy a few shares, then get distracted and stop. Or worse, they need money for something, sell their shares and start over from zero a year later. The people who actually build serious dividend income treat it like a non-negotiable bill. Every single month, no matter what, they're buying more dividend-paying stocks. Market up, market down, doesn't matter. They're buying. They understand that dividend investing is a long game, not a short game. This isn't day trading. This isn't trying to flip stocks for quick profits. This is systematically building a portfolio of high-quality businesses that will pay you for decades. Now let's talk about which companies actually pay dividends and why. Not every company pays dividends. Fast-growing tech companies like Tesla or Amazon historically haven't paid dividends because they're using every dollar of profit to grow as fast as possible. And that's fine. There's nothing wrong with that strategy. But mature, stable, profitable companies with consistent cash flow often choose to share profits with shareholders. We're talking about companies like Coca-Cola, which has paid dividends for over a century and has increased its dividend every single year for the past 62 years. Or Johnson & Johnson, increased dividend for over 60 consecutive years. Procter & Gamble, 68 straight years of dividend increases. These are companies that have been paying shareholders through recessions, wars, market crashes, pandemics, everything. They just keep paying. That reliability is worth its weight in gold when you're trying to build income you can count on. Here's a concept that will change how you see dividend investing forever. Dividend growth. A 5% dividend yield sounds great, but a 3% dividend yield that grows by 7% every year is actually way more valuable over time. Let me show you why. If you invest $10,000 in a stock yielding 5% that never increases, you'll get $500 a year forever. Sounds decent, but if you invest that same $10,000 in a stock yielding 3% that increases its dividend by 7% annually, in year 1 you get $300. Sure, that's less. But in year 10, you're getting $590. In year 20, you're getting $1,150 per year from that same initial investment. In year 30, you're getting over $2,200 annually. The slow and steady growers crush the high yielders over time because of compound growth. This is why investors obsess over companies with long histories of increasing dividends, not just paying dividends. But let's address the elephant in the room. What about taxes? Because yes, Uncle Sam wants his cut of your dividend income. In the United States, qualified dividends are taxed at a lower rate than regular income, which is a nice benefit. If you hold the stock for a certain period, your dividends might be taxed at 0, 15, or 20%, depending on your income level, compared to ordinary income tax rates that can be over 30%. Even better, if you're holding your dividend stocks inside a retirement account like a Roth IRA, those dividends can grow completely tax-free forever. Imagine building a portfolio that throws off $50,000 a year in dividends and never paying a penny of tax on it. That's the power of using the right accounts. This is why tax strategy matters just as much as investment strategy when you're building long-term wealth. Now here's where people mess up with dividend investing. They chase high yields without understanding the risks. If you see a stock paying a 10 or 12% dividend yield, that's a massive red flag, not a gift. Extremely high yields usually mean one of two things. Either the stock price has crashed because the company is in serious trouble, or it's some kind of sketchy investment that's unsustainable. Real, solid, reliable dividend payers typically yield between 2 and 6%. If someone's promising you 10 or 15% yields with no risk, they're either lying or they don't understand what they own. You want to look for companies with reasonable yields, strong balance sheets, consistent earnings, and a history of maintaining or growing their dividends over time. Quality beats yield every single time in dividend investing. Now, let me give you a framework for building a dividend portfolio that actually works. First, you want diversification across different sectors. Don't just buy all banks or all oil companies. You want consumer staples, healthcare, utilities, real estate, financials, industrials, spread across the economy. That way, if one sector struggles, your entire income stream doesn't collapse. Second, focus on dividend aristocrats and dividend kings. These are companies that have increased their dividends for 25 consecutive years or 50 consecutive years, respectively. These companies have proven they can pay shareholders through good times and bad times. Third, reinvest dividends automatically during the accumulation phase. Most brokerages offer dividend reinvestment plans where your dividends automatically buy more shares without you doing anything. This is how you accelerate the compound effect. And fourth, once you're ready to live off dividends, you can switch from reinvesting to receiving the cash. And boom, you've got passive income flowing into your account every quarter. Here's a real-world example to make this concrete. Let us say you build a portfolio of $250,000 in dividend stocks with an average yield of 4%. That portfolio is generating $10,000 per year in dividend income, which comes out to about $833 per month. That's not enough to retire on for most people, but it's a car payment, it's groceries, it's utilities, it's real money that you don't have to work for. And if those companies keep increasing their dividends by even 5% per year, in 10 years, your annual income from that same portfolio is over $16,000. In 20 years, it's over $42,000. Your cost of living might go up with inflation, but so do your dividend payments if you own quality companies. This is how people actually retire early or achieve financial independence. They build portfolios large enough that the dividend income covers their living expenses. But here's what nobody tells you about the psychological side of dividend investing. It's incredibly motivating. When you're just buying index funds for long-term growth, you don't really feel anything day to day. Sure, your account value goes up over time, but it's abstract. With dividends, you get these regular deposits of cash into your account. You see the money showing up. You see it growing quarter after quarter. That tangible feedback loop keeps you engaged and motivated to keep investing more. It's like planting a garden and actually getting to harvest vegetables instead of just watching the plants grow. You feel the progress, which makes you want to plant more seeds. This psychological element is why so many people who start dividend investing become absolutely obsessed with it. It's addictive in the best way possible. Let's talk about some common mistakes that destroy potential dividend income. Mistake number 1, panic selling during market crashes. When the market drops, dividend stocks usually drop too. But if the underlying business is still solid and still paying dividends, that drop is actually an opportunity to buy more shares at cheaper prices, which means higher yields. Selling during crashes locks in losses and kills your dividend snowball. Mistake number 2, ignoring dividend sustainability. Just because a company pays a dividend today doesn't mean they'll pay it forever. You need to check the payout ratio, which is the percentage of earnings being paid out as dividends. If a company is paying out more than 75 or 80% of earnings as dividends, that's risky. They have no cushion if earnings drop. Mistake number 3, forgetting about inflation. A 3% dividend yield sounds great until you realize inflation is running at 4%, meaning your purchasing power is actually decreasing. This is why dividend growth is so critical. Here's the beautiful part about dividend investing that most people never realize until they experience it. Dividend income is far more stable than stock prices. Stock prices bounce around like crazy, up 20% one year, down 15% the next. But dividend payments from quality companies stay remarkably consistent. During the 2008 financial crisis, the stock market dropped 50%, but most dividend aristocrats kept paying their dividends. Some even increased them. During the COVID crash in 2020, same thing. Prices crashed, but dividends kept flowing. The stability is why retirees love dividend stocks. They don't care if the stock price is bouncing around. They just care about the cash deposits showing up every quarter, so they can pay their bills. That reliability is priceless when you're depending on investment income to live. So how do you actually start building dividend income today? First, open a brokerage account if you don't have one already. Most major brokerages like Fidelity, Schwab, or Vanguard have zero commission trading now, which means you can buy dividend stocks without paying fees. Second, if you're just starting out, consider dividend-focused ETFs or index funds, something like the Vanguard Dividend Appreciation ETF or the Schwab US Dividend Equity ETF gives you instant diversification across hundreds of dividend-paying stocks. You don't need to pick individual companies if you don't want to. Third, set up automatic investments. Treat your dividend portfolio like a bill that has to be paid every month. Even if you're only investing $100 or $200 a month, that consistency over years and decades is what builds real wealth. And fourth, enable automatic dividend reinvestment so you're not tempted to spend those payments. Let the compound machine run for at least 10 or 15 years before you even think about living off the income. The reality is that dividend investing isn't sexy. It's not going to make you rich overnight. You're not going to brag to your friends about the $15 in dividends you collected this quarter. But 20 years from now, when you're collecting thousands of dollars per month in passive income while your friends are still grinding at jobs they hate, you'll understand why this strategy is so powerful. Dividend investing is the closest thing to a real-life money tree that exists. You plant it, you water it, you give it time, and eventually it starts producing fruit that you can harvest forever without killing the tree. Ronald Read understood this. The millionaires next door understand this. And now you understand it too. The only question is whether you'll actually take action or just think about it. Your future self is watching, hoping you make the right choice.